Today we have with us Nick Tippmann of TipTop Ventures talking about how to invest in a vertical SaaS just like the pros do. And we're seeing a lot of interest in vertical SaaS deals, especially in the early stage and for small companies. Vertical SaaS is one of the best ways to organize your business model, reduce the cost of actually launching a business because you're narrowing the focus into a specific vertical. And with the advent of AI and generative AI technologies, we're seeing them applied increasingly into vertical niches as well. And so I want to thank Nick for joining us today and have him kick off and give a presentation on this topic. If you have questions, go ahead and put them in the chat box, and we do our best to answer those as well. So I think we got the chat enabled right now. That should be working, and we'll go ahead and post your questions. With that, Nick, can you tell us more about your fund and yourself before we kick off?
Yeah, happy to, and thanks for having me. I'll move real quick to a slide here. It gives a little quick background, but I'm a founder, operator. Been in the tech world for about 15 years now. Started a few companies about a decade ago that didn't end up working out. Had some great learning experiences, but for the last decade or so, I was part of the founding team and CMO, head of marketing at a vertical SaaS company called Greenlight Guru, where we were able to bootstrap to tens of millions in ARR, and then brought on a capital partner with private equity and JMI equity with 120 million back in Q1 of 2020, and then had a great ride with them over the next 2 years or so, and left about 9 months ago now, and recently started up my own venture firm, which is a $10 million firm called TipTop Ventures, based in Austin, Texas, focused specifically in investing in pre-seed and seed vertical SaaS companies.
Great. Thanks for that background. We just had a life science event yesterday where they were showing Greenlight Guru's templates for doing regulatory compliance and QMS. So it looked like you guys have made quite a bit of progress in that space, and appreciate your joining us here today to talk about vertical SaaS in general. With that, let's go ahead and kick into your slides and talk about the topic of how do you invest in a vertical SaaS program?
Yeah, really appreciate it, Hall, and thanks everybody for joining here today. Really looking forward to chatting with y'all, and I got a presentation. Probably should take maybe 15-20 minutes, and then I think we're going to save 5 or 10 minutes for Q&A. So if you got questions, feel free to drop them in the chat as they come up, and we'll be sure to get to them at the end. So thank you. All right. Well, here's the agenda for today. So I want to talk a little bit, just a level set, a quick primer on vertical SaaS versus horizontal SaaS. What do we mean when we say vertical SaaS? Then talk a little bit about vertical SaaS maybe 10, 15 years ago versus what's going on today, like Hall had mentioned, around Gen AI and some different things, some different positive tailwinds coming for vertical SaaS. We'll talk about the benefits. And then finally, we'll close out with a framework that you can use when looking at investments, when looking at vertical SaaS startups and potential opportunities. Talk a little bit about a case study and how you could apply that framework to Greenlight Guru, the company that I was at. And then finally, just a quick summary on some key items to consider, and hopefully set it up for Matt's presentation with Unchained Systems afterwards, and you can get a good look and see what potentially a great match Matt is for this vertical SaaS model and what they got going on within Unchained Systems. All right, well, let's dive in. I gave you my quick background here. The highlight, just been in this space for a little over 10 years, and one of the early vertical SaaS players with Greenlight Guru, and was able to experience some of the differences firsthand, and really the strategic differences that you need to make when growing a vertical SaaS versus a horizontal, and how you go about that. So diving right on in here. Just a quick primer on what we mean when we say vertical versus horizontal. Over on the left, you'll see some of these vertical SaaS winners, and really some of these next gen vertical SaaS companies as well, like Toast and Built With and Convoy. And some of the big winners like Procore, Shopify, MindBody, really all over, and Viva, like, was in our space. And then you got your horizontal startups, and really this is startups that are built for a specific department. So think Salesforce with CRM, think Workday with human resource management, or kind of these new age startups that take more of a PLG motion, Calendly, Miro, Loom, Slack. But really, some of the key differences really come down to how you look at the team, you look at the TAM, and then you look at your growth strategy. And so we'll dive into a little bit of those later. But really, the high level is vertical SaaS is built tailored for a specific industry and for a specific customer set, like Greenlight Guru was with medtech. Versus horizontal, your sales force, you're going after the sales department, maybe the marketing, really the whole go-to-market engine, and you're going industry to industry, healthcare, manufacturing, you name it. So back a little over 10 years ago now, in 2013, when we founded Greenlight Guru, vertical SaaS wasn't quite as popular as it was or is now. One of the first firms out there that wrote a thesis on this is Emergence Capital, by their founder, Gordon Ritter, who led the original $5 million Series A check into Viva, kind of a famous check at this point, because that was the only money that they ever raised before they went public and IPO'd. And I haven't checked recently on the market, but they were a 20, 30, $40 billion company, depending on where multiples were over the last couple of years. And what Gordon put together in this thesis that he published back in 2014 really was a playbook for vertical SaaS companies, and some of the differences that you see in vertical SaaS versus horizontal SaaS, and really was really impactful and instrumental in the growth and how we designed and built Greenlight Guru. And we're able to experience some of these differences and benefits of the vertical SaaS model firsthand, but also some of the challenges as well. And Gordon talks about the 5 hallmarks of an industry cloud company or a vertical cloud company. Really, the first one is around the founding team. Typically, when you're looking at a SaaS company, you might be looking for one of the co-founders to have a go-to-market sales background, and your other co-founder to have a product technical background. But with vertical SaaS, you're really looking for that third piece of the puzzle with the subject matter expertise. And so really having a deep understanding of the customer's pains, the problems, and being able to empathize with the customer is really important and really key. Like our founder at Greenlight Guru, John Spear, was a medical device engineer for 20 plus years before getting together with our other founder, David Duram, and putting Greenlight Guru together. So really looking for those 3 key roles. The next one is really interesting, and particularly with all the advancements around Gen AI, and that is deep data. Vertical SaaS companies create one of their key advantages. They create a really robust and unique and proprietary customer data set. And there's a lot of ways that you can extract and provide value back to your customers using that data through things like benchmarking, or today on how you can use that to train LLM models and be able to really build a moat and differentiate with your unique and proprietary data some of these new large language models, leveraging that data that comes out of your system. Emergence Capital has another thesis around this with, they call it AI coaching networks. And many of you may have seen recently, there's kind of been a boom in these co-pilot companies. I think Microsoft's GitHub Copilot maybe is the most famous and recent example, but there's sales co-pilots. There's Harvey is a big Gen AI company that raised a ton of money earlier this year from some of the big names out in the Valley. That's a co-pilot for lawyers. But I think this is a trend that's only going to continue with these co-pilots for specific verticals, and vertical SaaS companies are some of the best companies positioned to take advantage of that and be able to build these co-pilot type products, leveraging that proprietary data. Kind of the third key difference, it really comes around the customer acquisition costs, because you're focused on a specific vertical, word of mouth really is a key part of your go-to-market strategy, and can be both positive and negative. So good word travels fast, but bad word does as well. And so it's really important that you have a great product and you really obsess over your customer experience and your net promoter score. Because on the flip side, people talk, and on the good side, that means it's going to lower your customer acquisition cost. You're going to be able to sell more products to that same customer, which we'll get into a little bit of data actually later that backs this up, that typically transitions into much lower customer acquisition costs, which makes these companies much more efficient, and actually makes them really resilient in times like the last year, or potentially if we go into a recession. We already have, won't get into the macro here, but vertical SaaS companies are some of the more resilient companies during this downturn because they are more capital efficient businesses because of this built-in word of mouth advantage that they have. Number 4 is really around the market dynamics that happen with vertical SaaS companies. In a horizontal market, the winner may take something like 5 or 10% market share, or a standout winner like Salesforce may have 20, or at the top end, 30% of the CRM market at any given time. Whereas in vertical SaaS markets, there's typically a winner take most dynamic, where the winner's gobbling up 40, 60, maybe even 70% of the market share, with maybe a number 2 player coming in at more your traditional 5, 10, 20%, and a long tail of others. But it really matters about being number 1 and number 2 even more in a vertical SaaS market. But that doesn't mean that there aren't long tail opportunities. I just look at Viva and life science and where we played with Greenlight. There's plenty of room for multiple players and winners. I think another good example there is Procore in construction. A lot of people believe that kind of construction is taken as a market by Procore, but when you dig in, there's just construction's such a big, fragmented, and unique industry that there's many of wedge products and many different applications, whether kind of on the front of the house or the back of the house, of opportunities as well. So that's really one of the reasons around the name TipTop Ventures is we're looking for the TipTop vertical SaaS companies. Those vertical SaaS companies, you really want to find your winners and ride and double down on them. And the final kind of hallmark of a vertical SaaS market is really around your product strategy, and what they call a layer cake product strategy. And this really comes down to creating additional products for that same customer. And so in Greenlight's case, we'll get into a case study later, but we came in with a wedge product. We transitioned in more to a full suite of products, and then into a platform, and really defining the category. And you're able to layer on these additional products and upsell them to your customers, again, helping with that lower customer acquisition cost. Whereas with a horizontal play, you're really going more vertical by vertical in your go-to-market motion, which is more expensive than just creating another product and selling it back to the same customer that you've already built trust with and built a great relationship with. So that's kind of then. When Greenlight was looking to raise our first money, kind of the conventional wisdom in VC land was that vertical SaaS markets, the TAMs were too small to be venture backable. And Greenlight ran into that with many investors and tried to tell our story and our growth story and strategy. But it was just kind of known or believed at the time that it was hard to support venture-sized outcomes in vertical SaaS back in 2013. However, as some of the big vertical SaaS winners of the kind of the last 5 years or so have realized, like Shopify and Toast, is that you can layer on fintech products on top of these SaaS platforms to really give you, put you in a unique pricing position. And what companies like Toast and Shopify, what you'll see, and Andreessen Horowitz did the research and published their thesis on this back in 2020, is that companies like that are now producing anywhere from 2 to 5x of their original SaaS revenue from financial services. Think about Toast as a POS at all restaurants, taking 50 basis points, 100 basis points per transaction, and getting somewhere up in 100 billion GMV, just really massive scale. Or you think about Service Titan, being able to offer different insurance products to the small businesses that are on their platform, all in a single interface, and then able to take a take rate on those insurance products, which typically ends up being one of the largest line items on any small business owner's balance sheet or cash flows. And so this fintech has really expanded the size of these vertical TAM markets by 2 to 5x at any given time, which has really just been a boon for investing in general. And so these are some of the latest vertical SaaS public company comps put together by Allied Advisors, looking at some of the differences in vertical SaaS versus horizontal. And really the big call out that I want to show here is just how efficient these vertical SaaS businesses can be. As you see on the median, it takes about half the capital it does for a vertical SaaS versus a horizontal to get to IPO. And if you think about that as investors and put our investor hat on, think about the lack of dilution and the greater ownership that you're having in these companies by getting in early and really riding them all the way through to success, whether that's acquisition, IPO, you name it. And this is just another slide here from Allied, diving a little bit deeper into the cash efficiency, and really post IPO, they continue to be one of the most capital efficient and resilient businesses. Really, another reason that we haven't chatted about here is many of these vertical SaaS businesses become the system of record for their industry, whether that's in the front office or the back office, or their product regulatory compliance data, like with Greenlight Guru, which makes them a lot more sticky, a lower churn profile. When you get up into the mid-market and the enterprise, it's really hard to rip these systems out. And you couple that with the lower customer acquisition costs that you get from the layer cake product strategy and the word of mouth that comes from marketing. And you see that these companies are spending anywhere from roughly half on their sales and marketing expense to revenue, and about a third on R&D to revenue. Now, one thing you may notice here, along with the positive outlook on the EBITDA margin, though, is that you actually see them have about 20-25% lower EV to revenue multiples. I was thinking about this, putting this presentation together, and really diving into why that is. And I think you'll see is that we're still a little early, and the power law here exists. And when you dive into the data and you look at some of these horizontal companies and the high flyers that are really pulling up some of these, the multiples, like the Salesforce, and looking for the next Salesforce in places like Datadog and not SalesBrick, but Snowflake, and Twilio, some of these that had the really high multiples, we haven't seen as many really mega winners in the vertical SaaS market yet, because it's still early. You've seen Shopify blow up, you've seen Viva blow up, you've seen Toast at their IPO. But I think over time, you're going to see these capital efficient vertical SaaS public companies continue to scale at a more capital, albeit maybe a little bit slower rate, but continue to gobble up TAM in doing so. And as I was alluding to, we're still really early, and I think we're seeing that in the multiples. And as you have more examples like the Vivas and the Shopifys and the Toasts of the world, and show that these can be 10, 20, $100 billion companies at scale, that you're going to see the multiples of those smaller companies and the multiples of the companies at IPO start to creep up and be more in line with their horizontal peers as well. But these are just two examples. Jason Lemkin, founder of SaaSter, SaaS influencer, I'm sure many of you know, sent out a tweet about a year ago or so talking that we're just at the beginning of vertical SaaS, talking about every industry will have a HubSpot of their vertical. I think this is around the time that he invested in a company, owner.com, doing this for restaurants that I was able to be an investor in as well. Pretty excited about. And then over here on the right, we have an article that was recently in TechCrunch Plus just a week or two ago, talking about vertical AI and what even the next extension from adding on fintech of what kind of vertical SaaS 3.0 can look like around some of these Gen AI solutions that I mentioned earlier, with the co-pilots, sales co-pilots, marketing co-pilots. Was just on with the founder actually literally right before this call today. That's built a very successful marketing co-pilot in the content marketing space, that they're popping up all over right now, and these vertical SaaS businesses really have an advantage in that area, and being able to put some real moats around their differentiation with these large language models. How am I doing on time? Coming up, just I'll breeze through on the next couple of slides. There's one resource that I want to really be sure to point to here. Dave Yuan, founder of Tidemark Capital, has put together just an amazing resource and really outsourced or open source decades of learning as one of kind of the preeminent and top vertical SaaS investors. He's on the board of vertical SaaS winners like Toast, like Dutchy, and this is just the best resource I've ever seen put together on this space and this vertical SaaS knowledge project, working on his experience, his colleagues' experience, and then other founders and executives from many of those vertical SaaS winners that we've been talking about today has put this together. And this is kind of the latest version of the framework that he's put together and how they look at and evaluate vertical SaaS companies, called Control Points 2.0. I won't get into all of this. I would really recommend going and reading that article that I linked here. I'm sure everybody will get the slides after the event here today. But really quickly, when you look at and evaluate Greenlight Guru in this lens of Control Points 1.0 and 2.0, Greenlight Guru started out kind of day one as a design control tool, and that was our wedge to get into the medical device market. We quickly, right on the heels of that, created our risk management and doc management solution, and that really rounded out our pre-market quality management solution. Thereafter, we then followed the workflow, followed the data, and added on our post-market quality processes, which really gave us the next iteration of our suite and our product offering, which was our medtech quality management system. And from there, we really focused on that growth as long as we could, until you kind of see the growth curve can start to flatten out, and you look at how do you layer on additional products to your original product line and continue to grow your ARR. And that's where we looked and both developed some products internally, which Greenlight Guru Academy, one of them that I had the pleasure of leading, as well as externally through M&A as well, where I also had the pleasure of leading our acquisition of Smart Trial, which was a clinical management solution in Denmark, focused specifically on the medical device space, to continue to expand across that value chain. And the next stage of growth is there for Greenlight. They're executing on it. There's a lot of room to run, whether that's through suppliers, employees, consumers. There's a lot of options for Greenlight Guru to continue to go. So to wrap it all up here, a quick summary, some of the key items to really focus on when you're looking at a vertical SaaS opportunity. One, the TAM, it is important. There still are two small markets, but you need to look at it with a different lens of what it looks like at scale if you can layer on some of these fintech products, marketplace, AI. The team makeup, we mentioned just how important having that subject matter expertise background is, maybe different than a horizontal play. Competition with that winner take most market dynamic, you really want to make sure. And then there's some nuances in the go-to-market and how you do that as well, which we talked about on that first slide around the product marketing and how you position things. So that's wrapping it up here. Paul, I'll pass it back over to you, and would love to answer any questions that we got.
Sure. So we had some questions from the audience. The first one was, how do these vertical SaaS companies price their product?
Yeah, it's a great question, and there's really a couple different pricing methodologies at the highest level that you can look at, whether it's a market penetration pricing model where you're kind of coming in low, trying to gobble up market share and raise it later. Do you want to maximize the revenue that you're getting from that first sale? I think what we've seen over time with that winner take all market dynamic and really wanting to find companies earlier in their life cycle and grow with them over time, a price maximization or market maximization pricing strategy, I think really works well. You really want to be careful, though, of getting into the habit of nickeling and diming your customers. They can get annoyed if you're constantly hitting them for this or that and adding them on. So how you package and price your product is very strategic to your growth strategy.
Great. So first question I had was, how narrow can you make a vertical SaaS? It seemed like you were not just getting into a specific application, but maybe as a department like HR inside an application or a company. How narrow can you make the total available market before it starts to not look like a venture deal anymore?
Yeah, so when I'm looking at deals personally, and with the fund, really looking for how can this company get to 100 million in ARR, and really looking at a bottoms up approach of that, of what is the ACV or the average revenue, average per account, average contract value times the number of players in that market. And maybe the ACV isn't where it needs to be to get to that 100 million in ARR today. But if you can see a path of how they would scale, leveraging the layer cake product strategy, adding additional products over time that would grow that ACV into a number where you could get to that 100 million in ARR, that's where I think it makes it venture investable. But another cool thing, I know we have some angels and family offices on here, and not everybody maybe needs venture-sized outcomes as well. One of the cool things about vertical SaaS, and Greenlight realized this, is a lot of these businesses can be bootstrapped and or only take on a friends and family round like we did in the beginning, 1.2 million, and you can have fantastic 100, 200x outcomes at a couple $100 million outcome because they don't take on as much dilution and as much capital.
Right. And so how much less funding do you need with a vertical SaaS? You saw the capital efficiency ratios, but if you had to convert that into funds raised, how much less do you think a vertical SaaS company needs to raise than a horizontal SaaS company?
I think it's kind of, there's almost a barbell answer to this question, depending on your go-to-market and the competitiveness of the market. If you have a giant market like Toast in restaurants and you have a clear advantage and you know that there's winners take all market, then that would really facilitate, like, let's go raise a ton of capital and let's gobble up this market as fast as we possibly can. Whereas somewhere like in Greenlight Guru space, where the number of medical device companies is much, much smaller globally than restaurants, you can get a little more capital efficient. And what we always looked at is, if we had additional money and we poured money on our go-to-market engine, would our increase in growth rate kind of outweigh the dilution or the hit that we would take from raising additional capital? And that was really the equation that we were always kind of looking at and examining if it made more sense. And it wasn't until we really felt like growing across that value chain and extending across the value chain and layering in and building new products and doing some M&A really was the right next growth strategy for us. Did it make sense for us to go and take outside money to execute on that strategy?
Great. Another question from the audience is, what stage do you invest in at your venture fund?
Yeah, so we invest TipTop Ventures at pre-seed and seed vertical SaaS companies, looking to write 100 to 250K checks alongside other leading investors. So we're not leading rounds, we're coming in alongside other leading investors, but we're often at the earliest stage working with different companies to help catalyze their round and bring other investors in as well. So typically I'm looking for an MVP out in the market. You have some customers, some traction, but probably below $1 million in ARR.
Great. And the other question is, how do you value vertical SaaS companies? What are the key criteria you look for to figure out what the valuation should be?
Yeah, so from a valuation perspective and how you look at the business, I don't think it's that different from any other SaaS company. So you're looking at TAM, you're looking at traction, you're looking at the team. You saw at scale, maybe there's a 20% difference in the multiple at the public markets, but really at the seed and pre-seed stage, most of these businesses are right in line of what you would see with horizontal SaaS. So I wouldn't say that there's anything unique outside your valuation criteria that you're already using.
So traditionally, SaaS has been 10x revenue, roughly cut, and it goes up and down a little bit with the market. Where do you think it is with vertical SaaS?
Yeah, I would say it's about right in line with that 10x multiple. I think last I was looking at it, I think Coatue put out a recent report from their East Meets West conference a couple of weeks ago. And I think the public multiples SaaS are still below the average or the 10-year average, around like 7.5, 8 right now. And I think that 10-year average is around 9 to 10. But Thomas Tungus at Redpoint Ventures also just put out a great article last week on valuing SaaS companies in Series A. And with the craziness of the market, he's saying there's really not a number that companies have to raise Series A. It used to be kind of 1 million. And I thought he had a really good anecdote in there that really predictability matters more in the early stages. If you're selling a story of a predictable growth engine, whether you're at 500K, a million, or 2 million in ARR, that could be more beneficial. And the market, the public markets, the last thing I'll say on that too, are starting to turn over. And you're seeing public markets started valuing SaaS companies based on efficiency and EBITDA and profitability, but it's kind of, the pendulum has swung back in the last couple of months where the top quartile group, the fastest growing group, is actually being highly correlated with growth again. And you've seen some stocks shoot up anywhere 40 to 120%, whereas that the unprofitable or the slower growth companies are still kind of in the penalty box, as Coatue was saying.
Okay. Well, question came is, why so low? Gross margins are huge. It's pure software.
I would say the same thing. I believe that the market has these mispriced. I believe that there's an arbitrage on these companies, and I think what we'll see over time and at scale, and I think the famous example is Constellation putting together their M&A and gobbling up highly profitable vertical SaaS companies. Another company that's really doing this, taking a very unique model with the PayFact angle, is Explorer. Also a vertical SaaS large acquirer like Constellation, but they're really looking at gobbling up as much GMV as they can under one roof, and then seeing how they own their own PayFac and can continue to get multiple expansion just from having more GMV to have better negotiating power with the payment rails.
Great. My last question has to do with AI generative models. There's large models and small models, and it seems like most companies now have to align with one of the standard platforms, especially on the horizontal SaaS. They have to align with OpenAI or whatever, because those are going to be the mainstays. But I've seen a lot of vertical SaaS companies and startups actually forego lining up with OpenAI, and they just start to roll their own or start to create a small model. Is that the right way to look at it?
Yeah, I'll be honest, Hall, this isn't my full area expertise, and I think we're all figuring out and learning along the way. I've seen that as well. I think NFX has a great generative AI layer stack of how they look at the stack, and you kind of have the foundational models, and then maybe a smaller subset of those, like Science.io as example for health. And then the third layer of that is really more these vertical focus specific LLMs, and using proprietary data to train them, whether that's with the larger chat GPT models, or if they're using something open source from Hugging Face or something like that. I think we're seeing it both ways, but I think David Sachs on the All In podcast, either this week or last, mentioned recently kind of one of the holy grail use cases of AI right now is building basically a firewall between your data and allowing it to be trained with these larger chat GPT models, the OpenAI, the Anthropic, and to do that without giving them access to your data and knowing that reliably. It's kind of like that holy grail use case right now. And so if that product exists and when it does, and people feel comfortable about that and the security of their data, I think you could see faster adoption and leveraging of these proprietary data sets with those larger language models and kind of the winners.
It just seems like with vertical SaaS, you could roll your own. I don't know how expensive it is to roll your own large language model on a small scale versus it doesn't seem like that would be possible with a very large language model that you would need in a more horizontal case. But we do see a lot of startups doing that right now, where they're doing the vertical SaaS with a small language model and having their own proprietary system and own proprietary data sets. And that's always the question of what's your training data that goes with that. What's your take on training data and how that might impact this as well?
Yeah, I think that's really the differentiator that these vertical SaaS companies have, is access to their large proprietary data set. Bloomberg is kind of the best example that I've seen, and one of the first movers and quickest movers in this. Bloomberg's data set has something like 78 billion endpoint or something. It's like more data points than Wikipedia. And they trained their own large language model with the Bloomberg proprietary data set. And the outcome of that is going to be a hugely defensible, large moat that nobody's going to be able to replicate that with the size of their data set. Now, not everybody has that luxury, but you look at some of the other big vertical SaaS companies like Toast in restaurants or Service Titan in construction, and you imagine how much data they're sitting on around their industries and what they know. And you see Toast getting into lending, getting into insurance, and leveraging that own first-party data that they have. I think they're going to be able to leverage that own first-party data in the same way to train these large language models.
Great. I think that's the end of our current questions. Thanks, Nick, so much for giving that presentation. Now we'll have Matt Smentik come up and talk about Unchained Systems. Nick, if you want to check out the chat box, if you want to add any comments to that as well. There was some question about the links to some of the content. I put one in there for David Ewens, but maybe you have better links as well. But with that, let's go ahead and bring up Matt. Matt, if you can go ahead and kick off. Love to hear more about Unchained Systems as an example of a vertical SaaS business.
Perfect. All right. And thanks, Nick. So I'm Matt, co-founder of Unchained Systems, where we're empowering personal services businesses to thrive. I bought my wife a diesel barbershop franchise in 2018. We opened our first store in 2019. And I worked at Apple for a number of years, 11 years at Apple, and realized how many challenges there are in this industry. So we get into the store, we build out our first location. I take 2 weeks off of work at Apple, and I'm running the front desk, and I'm stunned that a software solution that powers barbershops and hair salons and nail salons all over the country is so bad. So we've got this legacy software powering a $68 billion industry, and it's bad. So you take this from a couple different perspectives. From a franchisor perspective, they're trying to collect their royalty. My co-founder, Shane, who's the founder of Diesel Barbershop and Henley's Gentlemen's Grooming, he's trying to collect a royalty every week. And his controller, Shelly, has to go in and run 30 reports for every store every week and manually calculate the royalty and put it into another system. So the more he grows, the more work it is, and the less value add she's actually doing. She's doing manual work. There's no modern data and analytics in this industry. As a store owner, I spend about $1,000 a month on my 2 stores on marketing, and I have no idea where that ROI goes to. There's no way to close loop, do attribution marketing with the incumbent software platforms. Staffing post-COVID has been a significant challenge. Attracting and retaining staff and training them is continuously challenging. And then end customers are having a hard time booking appointments, and the cart abandonment rate is up to 90%. So what I'm thinking about is, what does the future look like? And if you think about like the first time you used OpenTable, right? You got a quick and easy registration. Your reservation was synced to your phone, had a clickable map in Apple or Google. Let's say you're running 5 minutes late. They've got a clickable link. So you call them and say, hey, I'm running late. Don't give away my appointment. Let's say you had a special dietary request. You're gluten-free, you're dairy-free, or I like the sauce on the side. How many times do they actually get that right? And then you think about during the checkout process, you're presented with this terminal while you're still at your seat, and they have a self-checkout process that is great, and you don't have to stand in line. Or you've got a paper bill with a QR code, which allows you to self-checkout on your own, automatically getting a digital receipt. What we're talking about there is really this system called Toast that Nick alluded to, which is now a publicly traded company with a $13 billion valuation cap and 85,000 locations. If you go talk to the folks running those in the stores, like I always do, I talk to the waiter and waitresses, like, hey, tell me about this system. And most of them say it's very profound. It's meaningfully improved their work quality, and it's improved the customer experience, which directly relates them to getting more tips. And so, you talk to the staff, and generally they're big fans. Now, imagine taking that same concept and applying it to the barbershop and personal services category. You've got a seamless online booking experience for your customers. As a franchisee, you're able to recoup your initial investment sooner, hopefully opening additional locations. And franchisors are earning more royalty and focused on strategic planning and opening more locations versus manual reports. So the solution to this is a platform that we're creating called Amplify by Unchained Systems. It's a vertical software as a service platform focused in on a superior digital experience for the end customers of the clients, the salon patrons, a superior store owner results focused on labor management, tracking digital ad spend, and increased franchisor capabilities with modern data and analytics to profitably grow the brand. Sorry, I got this popped up on here. So this is our ecosystem. So at the heart of our solution is a purpose-built point-of-sale customer relationship management system. A couple call-outs. Typically in this industry, the brand website and the booking website don't look anything alike, which leads to abandonment. And so we've solved that similar to what Squarespace has done, but apply it specifically to our vertical SaaS domain. Second is the easy registration and online booking. So like what we just talked about with OpenTable. And then all these microservices, as I call them, of inventory management, labor management, and scheduling to optimize the profitability for the store. We've been building out these capabilities, and what you see on the screen is about half of the core capabilities are done. We've got a robust roadmap to add additional capabilities, allows us to cut over additional stores over the rest of the year and into next. And recently we turned on online booking. This is late January, early February, and at the test store. And what you'll see is that there's increasing amount of new customers every month. There is some seasonality in this business, so May, June, July is typically a little bit of a dip. But if you contrast that with the ad spend per store per customer, we're actually able to measure and monitor this now, and from a Google ad to the brand booking website, from the brand website to the booking website. And so as you see, is the ad spend for customer acquisition is reducing, and so the customer acquisition cost is below the lifetime value of the customer in the first month. And we've never been able to measure this before, to my knowledge, in this industry. If you look at the total addressable market, IBISWorld just updated its recent numbers for hair and nails vertical. So there's roughly 1.9 million people, 1.4 million establishments. If you take what we're going to charge and apply it just to the US, it's a $9 billion TAM. If you look at just the franchisees and independent multi-store owners, it's about a $600 million TAM. And our low case is to get to 2,000 locations by 2029. It's a $40 million business. We'll talk about the layer cake approach here in a second. So our first customer is us. So my co-founder is Shane Brown. He's the founder of Diesels, Henleys, and Cowboy Up. They have 3 brands and 32 currently open locations across the US. He's got additional 6 stores under construction, and he sold licenses for 115 locations, which are scheduled to open by 2027. 2 of the brands have not yet started franchising, but are expected to shortly. Our second customer lined up is also an investor in Unchained Systems. This is Premier Cuts. They have 18 years in business with 5 locations across Central Texas. So this brings our store count to 43 without any sort of sales and marketing. Nick talked about go-to-market, and there were some questions about pricing. We want to bring people in on the core SaaS product and then expand the offering similar to the Dave Nguyen best practices. So once we get them in for the core SaaS product, then we want to expand out into digital co-pilot for scheduling and labor management. My wife spends 6 to 8 hours a month doing scheduling when it's really a problem that can be solved digitally with some of these co-pilot concepts and the smaller language learning models that we just talked about. And then ultimately we want to extend to the value chain and offer financial service products, right? So payroll integration is a quick win. Since we have the rich data set for the employees as well as the store, we think that there's financing loan opportunities where you can be a market maker and collect a fee. Maybe over time you go in and develop your own financing wing. So here's our core business model. 3 components that are live now. So there's a monthly recurring SaaS. For a smaller location like Premier Cuts that has less capability needs, $150 per month. For something like Shane's Brands, which are more complex, $250 a month per location. And then we get 30 basis points on credit card processing transaction. That's 90 to 95% of the revenue of these stores are coming in credit card versus cash. Ultimately, over time, as Nick mentioned, once you have enough revenue coming through, you can become a PayFac and capture up to 90 basis points of revenue on the credit card processing transactions, very similar to what Toast has done. And then we also make money on the industry standard 3 cents per text message reminder. So with the existing capabilities, it's $400 a month per seat. As we look at expanding the capabilities in 2024 and beyond, we plan to integrate with a instant tip, credit card tip payout third party. This allows the stylist to get paid their tips instantaneously. It also gives funding back to both the store and the platform. We talked about this smart scheduling AI for the store owners and managers. And your number one cost as a store owner is your variable labor for your staff. And so if you're over scheduling them or under scheduling them and not cutting labor, you can lose money quickly. And so most of the folks in the store are not, let's say, like Excel gurus who are looking at optimizing everything. And so we imagine a future where we've got this data and it gets pushed out as a notification to the manager, the owner, to add labor, cut labor, offer these services as a bolt-on to the existing services if there's additional time that's available. Here's our revenue from the initial stores. Basically, we're looking to have 300,000 in ARR without any sales as soon as we finish building out the platform. And this shows the financials going out to 2029 with the low use case, which is 2,000 stores and $40 million in revenue. My team here, Shane Brown, he's my co-founder. He's also the founder of Diesel, Henley, and Cowboy Up. I've been developing systems and products for 25 years, including 11 years at Apple. I helped develop these omni-channel programs that are used by millions of people. And we own the 2 Diesel Barbershop locations in Austin and plan to roll out up to 6 over the coming years. Parashah heads up engineering and product. He's been a leader with two exits. And we just added Braden as an advisor. He's a former COO of 2 different 100 million revenue startups. And he worked at Deloitte as well as Bridgewater and a company called Notel, which was a WeWork competitor. In summary, Amplify is a reoccurring revenue vertical SaaS business powering the original reoccurring revenue business, haircuts. We're targeted at franchisors and multi-store owners who want tools to scale and control their customers and brand experience. And we're extendable into other adjacencies over time: massage, med spa, acupuncture, chiropractic, and more. And think of us as a vertical SaaS and fintech investment. Today, we're announcing, you're the first to see it, a $2 million raise. This will be used to achieve $300,000 in ARR, develop the software, roll out these initial stores, and hire a team to start to develop the go-to-market playbook. We're going to do this in 2 tranches. The first tranche is $1 million at a $8 million valuation cap. The second tranche is $1 million at a $12 million valuation cap, as we'll likely make significant progress and start cutting over stores as we roll out tranche 1. And then we plan to do a Series A in probably late 2024, early 25, after the initial stores are live, raising a valuation. And with that, I will take any questions.
We had some questions come in on the chat box while you were speaking. We'll go through those. For those in the audience, we'll run a poll. For those who may want to find interest here, please mark that. So the first question is, why is this a barbershop product, Vertical SaaS? It is a generic technology and should be marketed as an engine customizable to everything from barbershops to restaurants to more.
Absolutely. So great call out from Andrew. We're leading with what we know right now. So we're building it in such a way that we're solving our own problems. This is the Microsoft eat your own dog food analogy. What we plan to do is hire consultants who are expertise in these adjacent domains and build out the complementary microservices that we don't possess and build those into the product over time. The key thing is, let's get it right for ourselves and be efficient stewards of the capital.
So great. So tell us more about your CTO background.
CTO background. So right now we've got the software development company that we're using is acting as a fractional CTO. We've got Paris on, who's our product and engineering, but we're using a third-party dev shop.
Okay. Is this written as an engine generic to its market?
It's fairly generic in terms of it could be used to these other adjacencies. There's going to be specific use cases which are important that we've not built out, that are non-hair specific. So we'll develop those over time, but that's kind of our initial use case.
So the next one is, there's no on-site footprint. So how do you handle scalability at the lowest levels of the code?
It's all software as a service. So as Nick talked about, many of the initial solutions are on-prem, fat clients that are installed. We're all SaaS-based, from scratch. How do you handle scalability at the lowest levels of the code? So I'm not exactly sure about that specific question, but if you're getting at like what happens if the store network goes down, you can, if you had, for example, an iPad with a cellular card, you can run the software off of an iPad via a browser. If the network goes down, and it runs just fine. I
think the question goes to, if you build it for a barbershop, how easily can you transport it over to a restaurant? At the low level, it tends to get very specific to the application.
I don't see us ever going into a restaurant or anything like that. I'd see tanning salons, chiropractic, tattoo parlors, other personal services type of industries, but I don't see a use case for restaurant necessarily. And Toast has already done such a phenomenal job there that I wouldn't want to compete.
Right. And what about thinking bigger about this and putting in bigger TAMs for multiple applications, not only just the barbershop, but all the other ones that you talked about? Or did you bake all of those into your total available market at the beginning?
That's just the initial hair, nails mark shot. So if you start to look at the additional adjacencies, it gets to 159 billion in terms of your TAM, just US. So this doesn't account for going international, which would be a kind of a next logical step.
And for additional revenue streams, can you do specific customization for each customer? Is that part of the model, or is that not?
You might do that. So if they want their own branded booking app, you could white label that and charge, a nice fee per month on that with pretty minimal incremental effort. And there's certainly the larger franchises would probably want that.
Great. And so my question is when you switch a barbershop from their homebrew to your system, what kind of ROI was the customer seeing there?
Well, we've only got the one store up and running right now. It was a brand new store, so we don't really have comparables to share. But we'd say generally the customer scaling of the test store versus other stores that we've experienced is 2x what it's been for historically Shane's other brands.
Great. And what do you think is the next step for you guys as far as go to market?
Well, we need to raise the money, hire the team, and identify a specific experienced person on GTM as it relates to vertical SaaS that has likely some industry knowledge as it relates to the personal services category. Shane and I will probably do the initial founder-led sales for kind of the initial period, and then bring on a junior person to really build up that playbook and put some dry powder behind it to amp things up in later part of this year, early part of 24.
Great. I think that's it for the questions that we have here. Any closing comments you have? And let's see. Nick, did you have any particular questions to ask?
Well, I was just going to say, fantastic job, Matt. And I fully endorse Unchained Systems. Really excited about this opportunity, looking to invest in my fund as well. And it's been very exciting working with Matt and Shane over the past couple of months, and just really love what they're putting together, the vision that they have, and really fits this vertical SaaS model really to a T, and they got the goods. So excited.
Well, thank you, Nick. Any other questions from anybody else?
We will send out follow-ups to the audience and see who may have more questions at this point. And we will say the chat box, there are many questions there as well. I think we're at the end of our time here now. I want to thank Nick for your presentation on vertical SaaS. It's quite informative. It's quite a bit of research there we need to do. Thank you for the links on that. And Matt, thank you for your presentation on Unchained Systems. It's a great application, a great example of vertical SaaS and how this is coming more and more, and the efficiency that comes with it as well. It seems to be very capital efficient, as well as a very focused go-to-market strategy, which is always a plus in the startup world as well. We'll want to thank you, our audience. Great questions you guys posed today. We'll be back in touch with the recording and updated materials to answer any more questions you may have, and glad to connect you with either of these guys if you have any questions for them. Anything else from your side, Matt?
No, thank you so much, Hall and Nick, and everyone who attended today. Appreciate it.
Great. Thanks, Nick. And with that, we'll go and close it out for today, and looking forward to seeing you guys next time.
Thanks, Hall. Thanks, everybody.
Thank you. Bye-bye.